Welcome traders, Maciej here from Taurus Trading. In this video I will share with you a few tips to help you decide which trading strategy might be the optimal choice considering your lifestyle. I guarantee that by the end of this short presentation it's gonna become clear that it's not so much system parameters or particular entry techniques that matter, but it is all about your personality and how much time you can actually commit. So let's get started. Trading strategy is a fixed plan that is designed to achieve a profitable return by going long or short in markets. A long position in a financial instrument means the investor owns a positive amount of the instrument. The holder of the position has the expectation that the financial instrument will increase in value. This is known as a bullish position. Going long in a future markets means the holder of the position is obliged to buy the underlying instrument at the contract price at expiry. The holder of the position will profit if the price of the underlying instrument goes up, as the price he will pay will be less than the market price. Being short in an asset means investing in such a way that the investor will profit if the value of the asset falls. There are a number of ways of achieving a short position. The most fundamental method is so-called physical short selling, which involves borrowing assets, often securities such as shares or bonds, and selling them. The investor will later purchase the same number of the same type of securities in order to return them to the lender. If the price has fallen between the time of the initial sale and the time the equivalent securities are repurchased, the investor will have made a profit equal to the difference. Conversely, if the price has risen, then the investor will bear a loss. The short seller must usually pay a fee to borrow the securities, charged at a particular rate over time, similar to an interest payment. Short positions can also be achieved through futures, forwards, or options. If the price of the asset falls below the agreed price, then the asset can be bought at the lower price before immediately being sold at the higher price specified in the forward or option contract. A short position can also be achieved through certain types of swap, such as contracts for differences (CFD). These are agreements between two parties to pay each other the difference if the price of an asset rises or falls, under which the party that will benefit if the price falls will have a short position. Speculators might sell short, hoping to realize a profit on an instrument that appears overvalued, just as long investors or speculators hope to profit from a rise in the price of an instrument that appears undervalued. Alternatively, traders or fund managers may use offsetting short positions to hedge certain risks that exist in a long position or a portfolio. During the 2008 financial crisis, critics argued that investors taking large short positions in struggling financial firms like Lehman Brothers, HBOs, and Morgan Stanley created instability in the stock market and placed additional downward pressure on prices. In response, a number of countries introduced restrictive regulations on short selling in 2008 and 2009. Naked short selling is the practice of short selling a tradable asset without first borrowing the security or ensuring that the security can be borrowed. It was this practice that was commonly restricted. Investors argued that it was the weakness of financial institutions, not short selling, that drove stocks to fall. In September 2008, the Securities Exchange Commission in the United States abruptly banned short sales, primarily in financial stocks, to protect companies under siege in the stock market. That ban expired several weeks later as regulators determined that the ban was not stabilizing the price of stocks. Trading strategies are based on fundamental or technical analysis or both. For every trading strategy, one needs to define assets to trade, entry and exit points, and money management rules. Bad money management can make a potentially profitable strategy unprofitable. Trading systems are usually verified by backtesting, where the process should follow the scientific method, and by forward testing, called paper trading, where they are tested in a simulated trading environment. Usually, the performance of a trading strategy is measured on the risk-adjusted basis. Probably the best known risk-adjusted performance measure is the Sharpe ratio. However, in practice, one usually compares the expected return against the volatility of returns or the maximum drawdown. Normally, higher expected returns implies higher volatility and drawdown. The choice of the risk-reward trade-off strongly depends on traders' risk preferences. Often, the performance is measured against a benchmark. The most common one is an exchange-traded fund on a stock index. A trading strategy can be executed by a trader, it's called discretionary trading, or automated, and it's called algorithmic trading. Algorithmic trading is a method of executing orders using automated, pre-programmed trading instructions, accounting for variables such as time, price, and volume. This type of trading attempts to leverage the speed and computational resources of computers relative to human traders. It is widely used by investment banks, pension funds, mutual funds, and hedge funds that may need to spread out the execution of a larger order or perform trades too fast for human traders to react to. A study in 2019 showed that around 92% of trading in the forex market was performed by trading algorithms rather than humans. Technical strategies can be broadly divided in the mean reversion and momentum groups. A long-short strategy consists of selecting a universe of equities, and after ranking them, we long the top percentile and short the bottom percentile of securities once every rebalancing period. A pairs trade is a trading strategy that involves matching a long position with a short position in two instruments with a high correlation. Swing trading attempts to capture short to medium-term gains in a security over a period of a few days to several weeks. Scalping specializes in profiting off of small price changes. Day trading is a style of trading in which traders open and close positions on the same day. Trading the news is the technique of making a profit by trading instruments just in time and in accordance to the occurrence of events. Day trading strategies can differ from longer-term trading strategies. They focus more on profiting from shorter-term movements in the market. They tend to be more action-packed and require traders to be present at their trading station throughout the session, monitoring the live price charts. It is widely accepted that the narrower a time frame a trader works in, the more risk they are likely to be exposed to, meaning that day trading is one of the riskiest approaches to the financial markets. It is not necessarily that the different strategies themselves carry more risk. In fact, the overall logic is the same for almost any time interval that exists. However, day trading rules tend to be more harsh and unforgiving to those who do not follow them. Mistakes are more costly and they have the potential to occur more frequently since the act of trading itself is occurring more frequently. A mean reversion trading strategy involves betting that prices will revert back towards the mean or average. This is a theory first observed by statistician Francis Galton and it explains how extreme events are usually followed by more normal events. A simplistic example of a mean reversion strategy is to buy a stock after it has had an unusually large fall in price. In other words, things tend to even out over time. When the current market price is less than the average price, the stock is considered attractive for purchase, with the expectation that the price will rise. When the current market price is above the average price, the market price is expected to fall. Among the major findings, one of the more interesting conclusions is that momentum and mean reversion can perfectly coexist in the stock market. In other words, the strategy of joining or fading the stock market's biggest winners can both be potentially profitable systems. Trend-following strategy seeks to capture trends across all markets using proper risk management. Trader should buy an asset when its price trend goes up and sell when its trend goes down, expecting price movements to continue. There are a number of different techniques, calculations, and timeframes that may be used to determine the general direction of the market to generate a trade signal, including the current market price calculation, moving averages, and channel breakouts. Traders who employ this strategy do not aim to forecast or predict specific price levels, they simply jump on the trend and ride it. Trend followers has to decide how much risk to accept, which markets to play, and how aggressively to increase and decrease the trading base as a function of equity change. These decisions are quite important, often more important than trade timing. Buy and hold is a passive investment strategy in which an investor buys assets and holds them for a long period regardless of fluctuations in the market. An investor who uses a buy and hold strategy actively selects investments but has no concern for short-term price movements and technical indicators. Many legendary investors such as Warren Buffett and Jack Bogle praise the buy and hold approach as an ideal for individuals seeking healthy long-term returns. Buy and hold investors tend to outperform active management on average over longer time horizons and after fees, and they can typically defer capital gain taxes. This is a passive investing style. Put simply, buy and hold investors believe that time in the market is a more prudent investment style than timing the market. It's extremely difficult to perfectly time the market, but it's easy to hold onto a stock. If you have found this video interesting and valuable, please consider subscribing to my channel. This way you won't miss my new presentations that are already in the works. I will also leave a link to my website so that you can increase the level of your knowledge regarding fundamentals of financial markets by simply getting instant access to the free ebook that I've put together recently. Thanks for watching and see you soon.